Hello, everybody. Can you hear me? All right. Welcome to this Bursa webinar. Today's our topic is REITs, the inside scoop. So how are you guys doing? If you are ready for this session, maybe you type ready in the chat group, okay? In the chat box. If you're ready for this, type ready. All right, fantastic. Okay, so this is Shane. I'm moderator for this session that is titled REITs, the Inside Scoop. Okay, so now as you know, REITs is a very important tool when it goes to the income investor. For those income investor, right, REITs is definitely a very important tool for them to get massive passive income, because the REITs itself is a very tax efficient investment instrument. All right, maybe later we'll talk, our speaker will talk more about that. So if you want to build massive stream of passive income, you should not miss out REITs, this instrument. All right, so later we're going to go deep into what are REITs and what are the emerging opportunities that come out from this pandemic for us to assess REITs landscape. Yeah, so that's what we're going to do today. So as usual, disclaimer. So whatever we share on this Bursa webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any companies that should we cover it as a case study in this presentation. So if you decide to make any investment decision as a result of this webinar, you're 100% responsible for your own risk. All right, cool. So it gives me a great pleasure to introduce our speaker today, and she's none other than Crystal Tay. So Crystal Tay is the head of investor relations for Sunway Berhad. So prior to the current role, Crystal was a senior manager, investor relations for Sunway Real Estate Investment Trust. She was instrumental in the formation of the investor relations functions of Sunway REIT. So she started her career as an investment analyst in Kuala Lumpur City Asset Management Sdn Bhd in 2000, followed by a TA Asset Management Sdn Bhd in 2004, where she managed unit trust funds and high net worth clients. So during her career in fund management, she was also attached to Hong Leong Assurance Berhad, Philip Capital Management Sdn Bhd, and RHB Asset Management Sdn Bhd. She has collectively 10 years of experience in the equity research, investment advisory, and fund management prior to embarking her career into investment relations. She's humbled to be awarded the investor relations for the mid-cap category in 2020 by the Malaysian Investor Relations Association and Best Investor Relations Team in 2019 by the Asset Hong Kong. So that is her humble profile. So without further ado, let's invite Miss Crystal Tay. Crystal, how are you today?
Hi, Shane. I'm good. Thank you for the introduction.
Good to have you on our Bursa webinar. So
it's my pleasure.
I shall stop sharing my screen and hand the control over to you.
Sure.
So we're going to learn REITs from you today.
Okay. I am currently sharing my screen.
Yes, we are seeing it.
Is it in the full Zoom mode?
Yes, right now it's in full presentation mode.
All right, great.
Fantastic.
Thank you.
All right.
So I'll take over, Shane?
Yes, you may take over.
All right, thank you, Shane. Once again, thank you, Shane, and thank you, Bursa Malaysia, for inviting me for a quick chat with you this evening. I hope all of you had your dinner. If not, perhaps I hope you don't mind listening to this presentation while enjoying your dinner this evening. What I'll do today is that for the benefits of maybe some of you who may not be very familiar with REITs, I will go through a little bit of introduction on REITs, which is also known as Real Estate Investment Trust. And then I would like to take this opportunity to also share a little bit on the landscape of REITs in Malaysia, especially in the last 18 months or so during the COVID pandemic. And subsequently, it is also related to the pandemic, what we noticed or what have we observed in terms of the new normal and also some of the opportunities arising from emerging trends. And subsequently, I think it is also in the minds of many of us, are we going to see rainbow after the storm that we have gone through in the last 1.5 years? So without further delay, I will go through the introduction on REITs. REIT, as what we usually call it in short, right? It stands for Real Estate Investment Trust. Essentially, it is a collective investment scheme that invests in a portfolio of income-generating real estate assets. And the objective of this investment portfolio, it is to distribute regular income distribution to investors or unit holders. In the context of the normal listed companies, our shareholders are known as shareholders, but in the context of REIT, we call them the unit holders. And for a REIT, investment in REIT, basically it is an avenue for us to invest in an indirect access to a large pool of real estate portfolio, including very iconic real estate portfolio or real estates in the country, such as the likes of KLCC, mega retail malls such as Pavilion, IGB's malls like the Mid Valley, the Gardens, as well as Sunway REITs mall such as Sunway Pyramid. So it is also an investment of assets that are professionally managed and governed by trusted, the stock exchange being Bursa Malaysia in the context of Malaysia, as well as Securities Commission of Malaysia. So this is essentially a very highly governed investment asset or securities that you will be investing in. And at the same time, I think one of the biggest, I would say, biggest benefit investing in a REIT is really because of its tax transparency. What does it mean essentially is if a REIT, say for example, Sunway REIT or IGB REIT, when they distribute their income, their distributable income, meaning the profit that they make, the realized profit which this REIT makes in every year, if they distribute at least 90% of the distributable income to unit holders, being you and I, in the form of usually we call dividend, but in the context of REITs, we actually call it distribution income, or some of you may have come across DPU, which is distribution per unit. Then the REIT will be exempted from corporate tax. Hence, you will hear a lot of times you say a REIT is non-taxable. That is what it means. However, that is at the REIT level. For investors like us, what we will be subjected to is a form of tax called withholding tax. For local and foreign retail investors, local and foreign institutional investors, they will be subjected to a 10% withholding tax. If a company or a corporate invests in a REIT, then they will be subjected to their prevailing corporate tax rate. So in that sense, a REIT, or rather the distribution income that you receive will still be subjected to a certain level of tax. Moving on this page, I just would like to share the concept of REIT and how does it work. Essentially, when a unit holder or investor invests in a REIT, the REIT will invest in a portfolio of properties. And this portfolio of properties can be commercial properties such as retail malls, hotels, industrial assets, educations, hospitals, and amongst others. And when the REIT invest in these properties, naturally we need somebody or we need a group of expertise to manage the operation of the REITs. So the REIT will hire, in the case of Malaysia, it is actually most of the time, we call it externally managed REIT manager, meaning a REIT manager that is not part of the REIT company. So this REIT manager will manage the overall strategic direction and strategies of the REIT, which include acquisitions, meaning when they acquire more properties to grow the portfolio. But in terms of day-to-day management of the property, the day-to-day management of the property, for example, operations, leasing, marketing activities, will be undertaken by another group of manager, which is known as property manager, that you can see in this chart. And in some cases, the REIT will also have a sponsor. Sponsor in the layman term is actually a promoter or a parent that will continue to build a pipeline of properties, which when they mature will be considered to be injected into the REIT as part of its expansion or growth plan. And the overall REIT structure will be overseen by another party called trustee. So trustee is appointed to act on behalf of unit holders in the best interest of unit holders for all the activities that is undertaken by the REIT or the REIT manager. So they are like the party that safeguard your investment. And as a unit holder, when we invest in the units of REITs, we will get regular income distribution in the form of distribution. So it will be distributed either on a quarterly basis or a semi-annual basis, depending on the mandate of the REIT itself. So usually the REIT will actually state that out during IPO in the prospectus, or on an annual basis for the continuation of the REIT. They will usually state it in the annual report or integrated report. Moving on to next page. This is just an illustration to share with you how do we relate to our investment in REIT. As a property investor, for example, when you invest in a property, or you invest in a property and subsequently lease it out to a third party, right? What we do is we will get rental income, and maybe sometimes after a couple of years, when the property appreciate, we will actually sell it off and get a capital gain. So in the case of investment in REITs, a REIT investor will invest in a REIT, of which the REIT will owns and manages a portfolio of properties. Like I mentioned earlier on, it could be in the retail segment, or in the hotel segment, in the offices segment, in the industrial, in education, in hospitals, amongst others. So with the investment in all these sectors, these properties will generate income. Most of the time it's in the form of rental income, and sometimes it could be any other income as ancillary incomes, which the total income subsequently will be distributed to unit holders. As you know, when we talk about the distribution and the tax exemption just now, right? Meaning 90% of this income, distributable income, net of expenses, or the property operating expenses, the REIT manager expense, fee, trustee fee, etc. The net of it, 90% will be distributed to you as distribution income. And then along the way, when the REIT grows, usually when a REIT which is active or proactive in growing its portfolio, for example, through acquiring more properties, or maybe through doing a lot of refurbishment, sometimes we call it asset enhancement initiatives in our terminology or our jargon, or AEI. That means the REIT manager proactively refresh and upgrade and rejuvenate or refurbish their assets to stay relevant, to even garner higher rental, for example. Those proactive activities will actually grow the income stream, and most of the time that will also translate back to your distribution income, as well as at the same time potential capital gains, or also in some contexts, like in the recent times where we have seen potential capital loss as well, because the capital gain or loss is by virtue of the movement in the unit price or share price. Yeah, and when you put the two together, that will give us, as an investor, the total return. So what is the advantage or key benefits of investing in REITs? I think in short and for simplicity reason, first of all, it is one way, and also it is also a low barrier to entry for us to invest in high quality, especially iconic commercial properties in the countries. For example, Petronas Twin Towers, or Pavilion Mall, or Sami Pyramid. Not many of us or individuals can afford in building or in acquiring that sort of property that goes into the billions of ringgit. So as a REIT investor, we have an indirect access or entry by investing through the REIT. Secondly, it is also the regular distribution income, which enables predictability in sustainable stream of income. As you know, maybe for some companies, or maybe most companies in Malaysia nowadays, they do have a dividend policy. They could have a policy of 20% of PAT or 50%. But in the case of REIT, we know for a fact that in order for the REIT to enjoy the tax exemption, the REIT has to distribute at least 90% of its distributable income. Hence, this is one of the reasons why when we relate or talk about REITs, we tend to say high distribution yield or dividend yield. That is the reason why the distribution yield is typically pretty decent or pretty high. And it is regular as well because it is in our mandate that we have to distribute the income either on a quarterly basis or a semi-annual basis. So that is another advantage or benefit or beauty of investing in REIT. Thirdly, it is in comparison to physical investment into properties such as landed properties or shop lots, for example, right? That may eventually sometimes lead to illiquidity or not liquid, whereby we may wish to dispose the property, but we couldn't match the deal with another buyer. Hence, that may drag for a while. But in the case of REIT investment, it is highly liquid, whereby it is traded on the stock exchange, just like any other stocks listed in the Bursa Malaysia. And the daily liquidity is always there with a very transparent daily pricing during the market trading hours. So if you are an investor and you would like to dispose or invest, right, you could do it any time of the day during the trading hour. Lastly, it is also professionally managed, which is important because in the case of properties, I think sometimes what differentiates a property, the quality of a property, in addition to location, which we all know location is very important. Other than that, it is also how well the property is being managed. So that skill of managing properties well, it's really another differentiating factor that differentiate the quality or the income of a property on the long term. Secondly, as mentioned just now also, this is a highly governed and transparent investment instrument. Hence, in terms of disclosure, in terms of corporate governance, in terms of regulation, they are very well governed in that sense. So moving on to the next section, I would like to share a little bit of time in the sharing with you on the landscape of the REIT in Malaysia, especially comparing pre-COVID to COVID, and how does it look like in terms of the industry, at this juncture. So on the industry landscape, currently in Malaysia, we have a total of 18 listed REITs listed on the Bursa Malaysia. In general, we can classify them into either specialized REITs or sometimes we call it focus REITs, where they focus on certain segment predominantly. And another segment of the REIT market is that the diversified REITs, whereby the REIT holds a more diversified set of portfolio whereby they invest in different subsectors. So as you can see here, some of this is the classification of all the REITs listed in Malaysia. For example, in the office space, we have the newly listed IGB Commercial REIT, and then Central REIT, which used to be known as Quill REITs, if you're familiar with that, which owns large sets of assets in the KL Central. Tower REIT, which is part of the Hong Leong Group, and then UOA. In the industrial space, Atrium is one of the pioneer, as well as they are also remaining very strong in the industrial segment. Healthcare, for example, our car healthcare, and then hospitality would be YTL Hospitality REIT. In the pure retail space, we have REITs such as IGB REIT, Hector REIT, and KIP REIT. In the diversified space, the more diversified REITs are the likes of Sunway REIT, Capital, CMMT, and also Al Salam REIT, which owns a more diversified set of portfolio. For example, in the case of Sunway REIT owns a portfolio of retail malls, hotels, offices, services which includes in the portfolio being education campuses and also hospital, as well as some REIT also own an industrial property. So it is a pretty well diversified kind of REIT. And subsequently, we also have the the focus type of REITs, whereby they are predominantly focused in certain sectors such as retail focus, meaning bulk of their portfolio is in retail, but they do have other components in their asset portfolio. In the case of Pavilion, it's predominantly or primarily retail, but they also have a little bit of office in their portfolio. Industrial focus will be Axis, which we all know. Axis is very, very well known. It is also the first REIT listed in Malaysia and has got tremendous track record in the industrial space. But beyond industrial space, they also have other components such as office space as well, and office focus such as M-REIT and KLCC, as well as Amanah Raya. Okay, I think this is where I think it's a little bit more interesting for me to share with you about some of the statistics and development in the REIT market in the last 1.5 years since COVID. I would like to make some comparison or bring you to appreciate that how has the REIT market in Malaysia responded to the COVID-19 pandemic. As we speak today, as at 30th of September, the market cap of the Malaysian REIT is at 38.6 billion ringgit. You know, when it first started in December, or when it first started in 2005, as at December 2005, the market cap for the M-REITs market were less than 1 billion ringgit. And it grew very well over the many years, over more than a decade long. And before the pandemic hits, you know, in December 2019, for example, the market cap of M-REITs have grown to 43.4 billion ringgit. And when the pandemic hits, of course, many of the REITs were also not insulated from the storm, and it was affected by the pandemic, and hence you see the market cap decline to current level of 38.6, primarily due to correction in the unit price, which I will share with you in a later stage, later pages as well. So the largest REIT listed in Malaysia by market cap is KLCC Stapled Group. KLCC Stapled Group is also the only stapled REIT in the country. What does it mean by stapled? It is actually a REIT that is stapled together with another securities, being an operating company that is KLCCP Properties Berhad. So they are the only stapled REIT in the country, and then followed by IGB, Sunway REIT, and Pavilion REIT. In fact, the top 5 REITs that you see on the left-hand side of this chart commands about more than 75% of the market cap in the country. So in the space of REIT market, it is quite skewed in the sense that there are only a handful of sizable large cap M-REITs that are highly investable, especially in the eyes of foreign investors. So when you talk about, why isn't M-REITs as popular as Singapore REITs, for example, this is one of the reasons, because the market cap or the size of our REITs in the country are not big enough and not many enough, of certain size to attract the foreign funds in a big way, unlike in Singapore. So on the next page, if you look at this chart, right, I would like to share with you, or rather, I would like you to appreciate, the fact that how have the REITs in Malaysia performed since COVID. I've taken January 2020, where if you recall, I think COVID hit the country or hit the world towards the end of January 2020, just before Chinese New Year in Malaysia, right? So from there, I compare the price and also the dividend yield that roll over to current state in September 2021. As you can see in this chart, right, I would say that the performance of M-REITs have largely reflected the fundamental or what M-REITs have gone through in the last 1.5 years in terms of their business performance, in terms of how adversely some sectors may be affected because of closure of business, because of closure of international borders, because of MCOs, the various phases of MCOs, for example. So it is very much priced in if you look at this chart itself. And at the same time, you also see that in terms of performance, it is quite a diverse range of performance from, as high as 44% gain in the last 1.5 years to a loss of equally as much as 44% down. So the ups and the down is quite a large range. And averagely, I think if you look at it, the average downfall of the M-REITs market over this period is around 10% that has came down. If you dive in a little bit more, you will notice that the sectors that are adversely hit or impacted by the COVID is really those with higher exposure to retail segment, as well as hospitality segment, being hotels, which we know that these two segments were quite adversely affected during the MCO, various phases of MCO periods, whereby for retail segment, during the full lockdown MCO, it is usually only permissible to essential services. As for the hotel segment, which is also affected mainly due to various restrictions, such as from the international border closure to interstate at certain point in time, as well as, at the peak of it, we even have inter-district restrictions. So all these have hindered the business performance of these segments. Hence, you see that some of these REITs with higher exposure tend to be affected a little bit more than the rest. Okay, this on the next page is on the this is to bring a little bit more perspective to share with you the performance, because I think many of us, a lot of times when we look at or analyze REIT, we will look at distribution yield, which is very true. So if you look at this chart, distribution yield does not fluctuate very, very greatly historically in the last 5 years, even during the pandemic time. So if you look at the average yield, right, distribution yield, it trended between the 6.6% during 2018 to a low of 5.1%, in 2019, in 2020 and 2021 during the pandemic time. But averagely, it is quite comfortable to say that the average distribution yield for M-REITs is in the 6%. Of course, certain REITs will tend to trade at a lower yield, because sometimes when the price moves up, that's why the yield will come down. So that is the reason why some of the REITs are trading at slightly lower yield than the industry average. So in terms of the other part of it, just now when we talk about it, we get distribution, we also get potential capital gains or capital loss, so which is represented in the red line. So if you look at it historically, yes, REIT prices do move up and down over the years. And as you can see, maybe from this 5 years chart, the low of close to negative 15% in a year for during 2020, during the COVID, and also, for example, during the 2018, when the expectation of interest rate hike going forward. So this is the times where you see the depreciation in unit prices. Other than that, most of the time, if you look at the annual return, or rather annual capital gain, it is between, ranges between the 8% and also say SI has a 12.5% in 2017. That brings the total return of a REIT, right? That can be from the 5%, assuming 5% is assuming very little capital gain, to as much as closer to 20%. So this range is actually a realistic range for you when you invest in a REIT. So when you look at companies, for example, a lot of, in most of the companies that we look at, we may be looking at, say, for example, PE ratio, price to book ratio. So in this case, this comparison, we'd like to share with you, it's similar to price to book ratio, but what we compare here is we call it premium or discount to NAV. And what we do is we use the current price of the unit of the REITs, comparing to the NAV, net asset value of the REIT at this point, a certain point in time. So we plotted two periods. One is pre-COVID, which is represented in green color, and the current moment as at 30th September, which is represented in pink or red color. So if you look at it, we observe that the price, the discount to NAV has actually widened from during pre-COVID averagely at around discount of 9% to today, the discount actually has widened to 22%. And what does it tell us is that when we compare this to the worth or to the asset value of the REIT, it is currently trading at a discount. That means it is trading at a cheaper valuation than what is the worth of the REIT at this juncture. So when it is positive, meaning that it is trading at a premium, that means it's higher than the NAV. So in this case, with the exception of IGB REIT, Axis REIT, Pavilion REIT, which are trading at still very high or healthy premium, the rest of the REITs, you will see that the discount or the premium has came off, or the discount has actually widened further. And what it tells you here in this message or in this chart is there is certain value that you may be able to extract based on the current price of the REIT that is currently trading in the market. But in terms of this, it is just at one point in time where we are comparing to the valuation. But you may also ask me, I'm sure you will also ask me, what is next? Based on this valuation, then what do I do and how do I evaluate? So this is where we will bring you to the next section, which is the new normal and also emerging trends. I think valuation aside at this point in time, to invest in a stock, we also look at the prospect and we also look at the opportunities that the business can present to us. So some of the key trends that we have observed or that has evolved very quickly during the pandemic is that all of us know we have many of us tried working from home, which in the past maybe some corporates or some companies were very reluctant to embark on this. And in this 1.5 year, what has really accelerated is the process of innovation as well as digitalization. And how do we apply this in the context of REIT, for example? So it is very obvious that for a REIT to survive and to compete, or to recover stronger and faster in the current situation is we need to evolve as well in our business model, in our business operation, business procedures as well. So with the trends such as online classes, online meeting, online shopping, product delivery, and last mile delivery, food delivery. So what does it mean to us? It essentially means that we have to evolve, and we have to evolve and adapt and innovate very quickly. So just to share with you, even amongst other listed companies or other companies, other business in the country have also evolved very quickly. For example, nowadays, we are getting used to or getting slowly accepting the fact that properties can be viewed virtually as well. So likewise, like leasing activities of our properties, whether in the offices, such as an office building, right? We can now also do leasing through the 360-degree view to lease properties in doing our marketing and leasing activities. Telemedicine, for example, teleconsultation, where it probably may not be as acceptable in the past, where we talk to our doctors or physician over an online platform or over a Zoom call, but today it is highly acceptable and people are very open to such practices. So these are the evolution in the shopping space, whereby during the closure of the shopping mall, or some of our tenants, they also became more innovative and continue to engage their customers through personal shopping services, or their sales assistant will contact the customers directly to continue to generate sales, although certain point in time where the malls may not, or their outlets may not be operating at the physical place. And of course, with Grab, with delivery, order, collect online, all this become a norm. Even hotel itself, have also evolved to deliver the hotel, 5-star kind of services or 5-star cuisines to our doorstep, which, in the past we will never or we probably have not imagined that having an afternoon tea at home, but today it is happening already. So on the retail side, I will share with you what are some of the key changes or evolution that we are seeing and we are expecting going forward. And this is really where the space that we feel that retail space will continue to innovate and evolve to be more engaging instead of just a shopping mall whereby you come in for window shopping. So with these trends that you see on this page, we are definitely leading to a new era or new sphere of retail experience. For example, Don Don Donki is one of the tenant that is very well known in Japan, and it is an attraction for certain shopping mall to attract customers to make a trip to visit or to patronize the shopping mall. Another concept is experiential retail, whereby you don't go in only purely for retailing or shopping, but it is also along the way during your journey in your shopping journey, you will also encounter very refreshing or very new kind of experiential retail, which is already happening in Malaysia. Some of them uses like VR, AR technology to engage us in a different way. Hybrid retailing, whereby we sometimes call it O2O, online to offline and offline to online, whereby it is a good marriage between the online and offline. In fact, Sunway Malls have recently launched its online platform eMall, which is called Sunway eMall. It is a platform to embark on this hybrid retailing, as well as at the same time it is an opportunity for us to assist and to support our tenants through another platform of retailing together with them. And of course, experiential in terms of retail tenant as in entertainment in a shopping mall, such as like you can see wall climbing and many more in the country as well as in overseas as well. Cloud kitchen is a new concept whereby it is a congregation of F&B outlets or F&B kitchen into one space. Last mile delivery that in overseas we already have drone delivering goods to our doorsteps. Okay. In the office space, we all know that even during pre-COVID, office segment has been pretty congested and or rather oversupplied in our term, right, in our industry term. And going forward, what we see, the trends that will transpire is we are already seeing, for example, more flexible working space arrangement, being flexi working space, flexi hours, also working from home, for example, and then which lead to more collaborative workspace. As well as with that, you may ask that does that mean that occupancy at office space may be at threat? We think that it is one whereby good quality offices such as those with green and MSC status offices will tend to be more resilient, because by virtue of higher adaptation or adoption of digital, right, we need better grade or higher grade of offices. So those will benefit. Another one is decentralization, whereby where some companies may start to looking at cost cutting and also not wanting to be in the CBD area, whereby we are constantly faced with traffic congestion. Then decentralization trend is also one trend that is prominent as well, especially in the areas where there is transit-oriented development, meaning there is infrastructure of public transportation and integrated developments, whereby it is connected to not only public transportation but also to other components such as retail, hotel, residential, etc. So these tend to be the trend or with better demand. And going forward, what we can envision or visualize is that working an office tower may not necessarily be a pure office tower in the future. It can be an integrated properties with co-working communal living space as well within an office tower, which it's already happening in Singapore. So in terms of hotel segment, I think hotel after the pandemic, many of the hotel operators will really look into how to recapture or regain the businesses which they have lost during the pandemic. And this leads to us having to evolve very quickly, adopt technology, as well as how do we engage the new breed of travelers post-pandemic. And some hotels have taken these opportunities during the lull period of the COVID to refurbish and refresh the properties, the hotels. And it is really timely that when the property is ready post-COVID, or as we move into endemic, that the demand will come back and they will enjoy the return of customers. Another few other concepts, I think, which hoteliers are working into differentiating themselves is from the offering of services, whether it is feel free, very basic, back to basic of businesses, or the more luxurious type, whereby luxury retreat, customizations of certain type of rooms or suites for their customers, and of course bringing in gastronomical experiences. I think because Malaysian, at the end of the day, we all love food. So this is how some of the trends that's evolving in the hotel segment. In terms of the emerging industry or emerging segment in the context of REIT space, I think this is by virtue of the globalization as well as global mega trends, where lead to growing population, lead to higher affluent, whereby with higher income population in the world, people will tend to command or demand for higher quality of healthcare services, education for their children, and also with the adoption of e-commerce, very, very high rate of e-commerce growth, that will lead to higher demand for logistic warehouses, data centers, and also other type of property industry, such as industrials, in the industrial space, whereby tenants may be looking for built-to-suit kind of properties which we cater and build specifically for that particular tenant. So these are some of the trends that we are seeing in the industry. So coming to the last part of the presentation, the question is, are we going to see, or do we expect to see rainbow coming after the storm, right? Well, as Shane has mentioned, this is not a recommendation of any particular REITs or any stocks, but I think it is, we would like to take this opportunity to share with you some of our observations and views as if what we foresee the industry will be heading in the next 6 months, 1 year, and long term moving forward. So for example, in the retail space, for the retail space, if you look at it in the short term, we are pretty encouraged with the recent recovery in retail footfall, particularly in the month of October and now moving into September. In fact, we are quite optimistic in terms of the recovery in footfall moving into the last part of the year, whereby we are moving into the festive season of Christmas and then moving on to next year into the Chinese New Year. And we have observed quite strong recovery in terms of retail footfall, and it is also an indication that the public are more comfortable to visit public spaces based on what we have seen. I think it is also highly supported by the fact that the country or the nation has achieved 90% of vaccination rate for adult population, and the teenager are also gradually being vaccinated. In fact, I think this week the third booster is also being implemented for starting with the elderly. So that has given certain level of comfort for consumers to be back in the open space again. So that will bode well for the retail segment. And also for landlord and retail mall owners, what is important for us is that we need to ensure that we continue to provide a safe and hygienic space to the consumers, as well as continue to support our tenants in the next couple of months, if not in the next 1 year, because I think what we have lost in the last during the pandemic is confidence, and confidence building is very important to bring our stakeholders back together, to overcome and to be moving to progress towards the endemic level, as well as for our life to be back, as usual, business as usual. So in the mid-term, or in fact in the short term, we do expect, or we do anticipate, certain level of revenge spending that may stimulate pent-up demand to the retail sales in the retail malls. And why do we say that? Is that I think as much as we have getting more adept to online retailing, there are still quite a number of services or products that we may still wish to experience it at the physical premise, where we can touch and feel the product. So with the reopening of the economy, and for us to be able to be out and about again, so the revenge spending is also a factor that we expect in the short term to medium term, as well as whilst international borders are still not perfectly open, not totally open, the shopping money that has been spent overseas, may still stay in the country. So that's why we feel that the opportunity for revenge spending will be there. And for retailers in the medium term, and landlord as well, we need to adjust to the new normal. And we think that the new normal will be here to stay for a while, such as capacity, such as social distancing rules, as well as we mentioned just now, the hygiene factor and the safety measures. It will continue to be here for good until the medium term, post-endemic as well. So we feel that so for businesses, we need to adjust to the new norm, especially for certain, which is more pertinent to certain industries such as entertainment, cinema, indoor attractions, where it involves a lot of touch points. So that kind of industry will tend to be more sensitive, and hence, even more enhanced precautionary measures need to be considered. On the long term, I think the economic fundamental is supporting the recovery, and the expectation of economic recovery or stronger recovery next year, as well as what is very important is also stable employment rate, whereby if we are comfortable with our job prospect or our business prospect, I think that is very important to support the recovery for the retail segment, because that is when we are more comfortable to indulge a little bit more, to spend a little bit more. So employment stability is very important to support the recovery. So despite digital sales taking over the scene during MCO period, we think that retail malls will continue to be relevant, but the business model will change. Perhaps to focus more on retail experiences, entertainment, and social gathering we call it a congregator, where it congregates people and bring people into a premise. Being a shopping mall, for example, is paramount to a healthy community living. Many people do say that we cannot be perpetually locked down. We cannot be locked down forever, which is not good for the mental health. So in this case, there is some truth to this kind of statement, and we think that on the long-term basis, retail mall will remain relevant. Okay, moving on to the office segment. So the hotel segment. On the hotel segment, in short, I think short term will be we will see certain level of pent-up demand coming from domestic leisure travelers and also business travelers. But it may not recover to the pre-COVID level, because for us to recover to the pre-COVID level, we need the international market or international border to fully reopen or liberalize. So that is the view. So from medium to short term, there should be a certain level of pent-up demand from the domestic travelers, for leisure travelers, and also with the same logic that whilst international traveling has not fully reopened, it also means that for the local to travel internationally is still not fully possible. Certain countries have opened up, but not every part of the world. So, the traveling money will still be retained in the economy. So that is why medium to short term, it will benefit the domestic leisure market. But for a full recovery, we believe that the international travel needs to be fully resumed in order to bring the industry to the pre-pandemic level. On the office segment, I think in the short term, for many businesses during the COVID pandemic, for us, for businesses, it is very important to preserve cash and delay capital expenditure. So with this, in the short term, we will see that lesser activities in the office space, whereby for a business to grow or to expand their space requirement, they may hold back a little bit more longer to watch for, with a watch and see situation or mindset. And for companies, they may also still continue to look for avenues to cut costs further in this recovery stage. So that, like what I mentioned earlier, presents some opportunities to the decentralization offices and also possibility of shrinkage in office space also possible, but we are not seeing that happening in a big wave. Working from home, in our opinion, will be a trend moving into more of medium to long term, because ultimately, I think in the context of Malaysian culture, multinationals are more open to work from home or flexi working space arrangement. But in the local context, we feel that in the short term, given a choice, employers will still prefer their employees to be working back in the office. So working from home is likely to be more of a medium-term kind of trend instead of an immediate threat to the office sector. On the long term, I think we will have to go back to the fundamental of office space supply in the country. As office space supply continue to build, so it is going to continue to remain very challenging because of oversupply situation. And it is really a case of survival of the fittest for office buildings, where the offices will need to evolve to cater to the new demand, such as integrated development. And like I mentioned earlier on, an office space may not be a pure office anymore going forward. It could be a mixed tenancy where it incorporates a more hybrid type of tenancy, such as offices, service providers that complement the population in the office, such as gymnasium, education center, childcare, and etc. So we think the office space market will continue to evolve to cater to the newer demand going forward, and also the mentality of working population going forward. Okay, industrial, this is where we feel that the bright spot of the industry is probably in the industrial and services sector, whereby the continuation of e-commerce will continue to drive the demand of properties in this space, being the warehouses, the logistic companies, the last mile delivery, and that will bring it to the medium term demand as well. So we are quite optimistic on prospect for the industrial and services, as well as going forward. I think as the nation gets more digitalized, then it will lead to the demand for other type of properties, such as the data centers, like what you see in the West. Okay, with that, that actually sums up my presentation. I would like to also encourage you that if you would like to, have the pleasure of understanding more about REITs and certain trends surrounding the REIT industry, perhaps you could also follow this column by Datuk Jeffrey himself, where he addresses on a monthly basis on Saturday, last Saturday of the month, whereby we do discuss quite interesting topics surrounding the REIT market in the country. So with that, I shall end my presentation and open the line to Q&A.
Yes, thank you so much, Crystal, for the wonderful presentation on REIT.
Okay, I believe I've unshared the line.
Yeah, I think many of our attendees give you a very positive remarks. Okay.
Oh, okay.
Well written, well presentation. Okay, and very nice deck. So yes, so if any questions for Crystal, you may write in the Q&A box, yeah, not the chat box, okay? Because if you write in the chat box, we a lot more messages come in, we may overlook your questions. So write in the chat box so we can address it to our speaker today.
Okay, I already see some question in there.
Yeah, maybe I will moderate it for you.
Sure, thanks.
But if there are any question that you really want to address, then you let me know, okay? Because
Sure.
due to time constraint, we may not be able to answer all questions.
No worries. I am okay to any questions. So you just feel free to moderate. Yep.
Now, the first question is asking, are you aware which REIT pay less than 90% of the profit?
Okay, based on my understanding, there is none. Because it is actually a regulatory breach if you do not pay 90% of the distributable income. That said, in Singapore, what they have allowed in Singapore during the pandemic is that in the next 1 year from last year, the REITs can actually hold back the distribution in Singapore. But in Malaysia, we still have to continue to pay.
Yeah, nice. Yeah, I think if they don't declare more than 90% of their income, right, that would defeat the purpose of a REIT, right?
It's just that I think if you are REIT investors in the last 1 year, you may have realized or experienced the fact that your distribution has been lower. And that is because of the lower revenue, lower rental that we are getting from our businesses, our tenants, and other properties. So this doesn't mean that it is to perpetuity, because when the business recovers, that's where when our income recover in tandem, right, with the recovery, then we will have the ability to continue to pay hopefully higher distribution going forward.
Yes, definitely. The next question is asked by ST. Apart from parking receipt, right, does retail REIT generate income from a percentage of sales from tenants, or it's just merely a fixed rental from the tenants?
In general, they do. So what a REIT charges is that most of the time is a base rent, which is the basic rent on the premise cost. And on top of that, if the tenant perform to a certain level, there is a threshold or watermark. If you do better than certain watermark, then the landlord or the REIT will get to enjoy a certain percentage of your tenant sales. So if you analyze REIT, right, on certain quarters we put aside the pandemic times, but in certain quarters, sometimes technically there is no seasonality if it is purely on a fixed rent, right? Because every quarter or every month the tenant will pay the same rental. But from time to time, you realize that some REITs, their income has gone up even though they didn't buy any additional property. So those seasonality is actually most of the time contributed by the turnover sharing. That means certain times, certain tenants will do better, especially during the festive season. Then as a REIT investor, where the landlord enjoy a little bit more of the turnover sharing, we will also get higher dividend.
Oh, okay. That's interesting.
Yeah.
So the landlord really needs to have a system that can keep track of the sales of all the tenants.
Yes, in the country, the turnover sharing is not very material, but it is something that it is expected to grow over time. So what is important is also when a REIT manager, or just now when you mentioned, right, a good manager, if you are able to bring in very good tenants, performing tenants, then hence our upside is on the turnover sharing as well when the tenants do well.
Okay, I see. The next question is asked by PL. Do you know that for management, trustee, and property fees, right, will make up how many % of the annual revenue on average?
It is not material, but to answer that question, what you can see is that in our P&L, right, after technically you will see the revenue and then minus all the property related expenses, and you get NPI, we call it net property income. From the net property income, below there is all the expenses. It is not material. It is a certain percentage of the total asset value, and also and certain portion, very small portion of performance fee.
Okay, understand. So the next question is, how likely will the REIT still provide discount to the tenants, and to what extent the retail-based REIT has recovered compared to the pre-pandemic?
Okay, so maybe for this question, if I may put a small little disclaimer, is that perhaps I will share in the views based on Sunway, because I think it's not fair to generalize with other REITs in the country as well. For example, it is not fair for me to be speaking or representing Pavilion or IGB. Maybe I'll share from Sunway perspective. Yeah.
Yes.
For our Sunway malls, we are of the opinion that the rental support will continue to be around in the next couple of months, easily in the next 6 months, because but it has always been on a case-to-case basis. So meaning we do look at the performance of the tenants. It is not a blanket rental rebate that is given to every single tenant. So it also depends on their performance, whether do they require this kind of support from the landlord. So that is number one. Secondly, is also as we see in the current trend in the last 1.5 months, I think we are pretty optimistic in the sense that the recovery of the footfall has been very encouraging. So we foresee the ability and the opportunity for us to gradually reduce the rental support over time. But to answer the question, will it still be there? We think that it will still be there in the short term.
For the next 6 months,
at least, because it still takes time for tenants to recover to the pre-COVID level for various reasons, various factors, because not all tenants will immediately recover, so we foresee it will still be there for a while.
Yeah, like what you said, some tenants are capacity-based tenants, right?
Yes. So like restaurant, for example, although it may be packed, even in the fashion outlet or any outlet, right, it may be packed, but at the same time, they are still constrained by capacity, because there is a maximum number that is permitted in the shop lot at one point in time, or at any point in time. So ultimately, we are not operating at full capacity as pre-pandemic.
If I'm not mistaken,
that's why you see a lot more queue nowadays, also because of the capacity.
Some queue are actually still pretty long. If I'm not mistaken, Sunway REIT is one of the first few landlords who really first give out this kind of rental support to the tenants.
Yes.
And now the rental support is still here.
We were the first to announce. Then actually, subsequently, in the next 1-2 days, the other landlord also announced at the same time.
So you give pressure to the industry players.
Not really, but we felt that it was crucial for us to support our tenants, because we believe in the long-term relationship. It is not touch and go. We are here for good, so we should go through this together with our tenants and our business partners.
Thank you so much, Crystal. Next question is, after COVID, right, work from home will be applied in all industries. So which REIT type will be the worst, and then which REIT type will be the least affected, in your opinion?
Okay, I would say maybe I may choose to differ slightly from this in terms of the view of working from home. While some industry have openly accepted working from home or hybrid working environment arrangement, but in actual fact, we also aware of maybe companies which are not ready for this kind of arrangement. So it will be pretty mixed in terms of the demand and outlook for the office spaces. It all depends on I would say on the industries, and also on the nature of the businesses, whether they are MNCs or they're local corporates. So essentially, I think the work from home culture will not be an immediate threat to the industry. So to answer which sectors will be, I think office spaces will be quite, I would say quite stable, if I may say that, because I don't think this trend will immediately give a big threat to the office portfolio in our M-REIT space. But if you go across other industries, then in the COVID pandemic times in the last 1.5 years, industrial and office have remained pretty resilient by virtue of the fact that they have not been as affected as the retail and hotel. So if you have to rank it in that manner, then maybe the retail and the hotels have been more affected in terms of recovery expectation. Retail will probably recover a bit faster than the hotel because hotel will still be constricted by the international border, in the short term.
All right. Yeah. The next question is by ST. This question is a bit more, asking about economy cycle. All right. So the capital gain and loss chart show that 1 year up followed by another year down and repeat itself. So though next year tend to be a recovery year, so the question here is, would the history repeat and present a year that is coming down?
Oh, okay. I think maybe the graph happens to be in that manner, but one of the way to understand a REIT cycle, right? It's definitely economic cycle has bearing on the businesses of the REIT because ultimately we are provider of businesses space to the community, right? Definitely the economic cycle will have an impact. Secondly, I think what is pretty sensitive in the context of REIT is interest rate cycle. So on certain years where you see the down years, with except COVID in 2020, in the past, many times where the down cycle is affected by the expectation of interest rate hike. Why is that so? Is because, as you know, two reasons. One is that when interest rate goes higher, it means that borrowing cost is higher. And just when you asked, right, the cost component of a REIT, interest is one of the cost component after the NPI as well, which is quite substantial. So that is the reason when interest rate expectation of going up, it has a negative sentiment on REIT. That's number one. Secondly, is also because when interest rate goes up, REIT is a dividend or distribution yield investment instrument. So investors will tend to compare that with their comparative, such as like for institutional investors, then they will compare with the bonds, the fixed income. When interest rate goes up, then maybe the fixed income market bond yield will go up. Then hence it's a relative comparison where they will switch out of the REIT or switch back to US, for example. And then in the case of retail investors like us, we will compare with our FD rates. When interest rate go up, so maybe we earn a little bit more from the FD. And then some investors may not want to invest in REIT because ultimately REIT is still an equity, right, that has got a potential capital loss or gain. So if interest rate goes up to a level that FD provides you very comfortable return, then there is also a trend where some investor may withdraw from REIT and they move back to FD. So that is the reason why when interest rate is expected to go up, the sentiment on REITs typically will be more negative. So that is the main reason that has contributed to the lower return in certain years.
Yeah, nice analysis, Crystal. The next question is in relation to the prosperity tax. As you know that in budget 2022, prosperity tax is proposed for next year. So do you think that REITs are going to be affected by this?
Okay, based on our understanding is that REIT is unlikely to be affected by this for two reasons. One is that it is taxed at the entity level. So in fact, in reality, right, when we look at the P&L, it is not at the consolidated level of the listed company or the listed REIT because it is taxed at the entity level. So it is at the subsidiary level or the JV or the associate level. So you have got so many entities or different companies within a large group of companies. So it is not as detrimental as how we think it may be. Secondly, in the context of REIT, it is also because the prosperity tax is not applicable as long as the REIT continues to distribute at least 90% of its distributable income. So this is the real beauty of a REIT, because if we continue to distribute 90% of our distributable income, the REIT will be tax exempted. Hence, prosperity tax will not be applicable in this context.
Definitely.
Yep.
Right. Let me see the next question. Now, do you know which website can we refer to check on the DPU, gearing, net tangible asset, and etc. on the M-REIT?
I think quite a number of people, the regular ones, they do have already. If I'm not wrong, I think the KL
SC screener.
Yes, the KLSC screener is quite has got quite detailed information, quite thorough information. Other than that, actually in Bursa website also you can see some indications of the prices and also the yield.
Yeah, on Bursa Marketplace, definitely you can find prices. But I'm not sure about DPU, whether Bursa Marketplace do break down the DPU or not.
They have the yield, but not in DPU.
Yeah.
Yeah.
So for DPU of each individual REIT, right, I think you need to refer to Bursa Marketplace official announcement to check every single quarter.
Or the REIT's annual report. Actually, the annual report is quite useful in showing their historical trend as well.
Yeah.
Annual report, yeah.
So the next question is asked by Johnson. Do you know what is the maximum allowable gearing for M-REITs?
50%. It is 50% of total asset value. So the gearing formula is slightly different from the normal companies or listed codes. So it is 50% of total asset value. During the pandemic, actually, the Securities Commission has relaxed a little bit to 60% for the next 2 years. That state, the REITs are, I would say all REITs are not likely to raise it to that level, because it is an interim relaxation, which means after 2 years we have to bring it down to below 50. So to us, we think that it is not practical to do so unless this relaxation is also because by virtue of the risk of devaluation in properties, because during pandemic, sometimes when we do our revaluation of our asset of properties annually, right, some properties may be devalued or the price came down, the valuation came off, and when the valuation came off, it will trigger the gearing level. So that relaxation is given on that premise. So the permissible gearing is 50%.
Okay. Hasman would like to ask, would diversified REITs be more resilient to the market demand? It seems like they have a natural hedge towards the market uncertainty.
It is a very interesting question. Maybe sharing in the context of Sunway, right? When Sunway REIT was listed 11 years ago, it was very much a retail-focused REIT back then. So over the years, as we realize that more and more segments are getting more competitive. Like you read property report, you will see that hotel is getting more competitive with oversupply, office are getting more competitive with oversupply, as well as emerging opportunities in the emerging markets or emerging subsectors. That's over the last three years, Sunway REIT has decided to diversify its portfolio. And with that, right, I think as a case study, it's interesting to note that the diversification has helped us in providing more cushion to the downside and also bolstering our income. Had we not had the diversified assets such as the hospital, the education, the industrial properties in the Sunway REIT, right, and rely very heavily on hotel and retail, the pandemic effect this time around could have been even greater for Sunway REIT. So to answer the question in short, we do believe that diversification in the right segment does help, especially in lengthening or in providing stability in income, because certain sectors, their leases tend to be long, very long duration, in the industrial space, in the hospital, for example, right? So that gives us certainty of income in the next 10 years, for example, without having to worry too much about rental reversion. about occupancy rate, for example. So it does help to a certain level.
All right. Thank you so much, Crystal. The next question is by Chris. For the withholding tax in the hand of the unit holder, the actual distribution received on hand, is it after net 10% withholding tax?
Yes, what you receive in hand is already net of the withholding tax because it is deducted by the REIT manager on behalf of the unit holders.
Yeah, so the unit holders don't have to declare this,
Yes, it's
for
already
your income tax filing.
Yep.
Okay, so we addressed that question. Okay. Wong would like to ask, do you foresee any organization restructuring among the M-REITs, such as merger and acquisition, listing or delisting?
Potentially. I mean, in all businesses, there is always potential of such activities, whether it's M&As, M&As is potential, because I think sometimes it may also be good for the industry because some merger will create stronger or more synergy amongst two REITs, for example. So that is potentially something that can happen in the next couple of years. Not surprising.
Lim asked this question: why is Singapore REITs perform better than Malaysian REITs in terms of dividends and growth? How do we choose a high quality REITs for Malaysia?
Okay, that is a very interesting question. I hope I have an interesting answer for you, but maybe I will share observations. I think in general, it is relating to the underlying strategy of the REIT itself as well. As you know, REIT in Singapore is a lot more dynamic in terms of their investment strategies, in terms of their investment geographies. For example, quite a number of quite a big portion of REITs in Singapore have overseas investment, for example, in overseas market, overseas assets. Whereas in Malaysia, we are all, most of our properties are in Malaysia, with the exception of YTL REITs that they have properties in Brisbane, for example, in Australia. So that is one level of dynamism, and also in terms of their acquisition strategies, they are also more active in comparison to the REIT manager, because I think their market is a lot more bigger. They are open to overseas investment countries as well. So that potentially can answer your question, why do they grow faster? Because ultimately is, if we own one house, right, we get rental from one property. But if we own 10 houses, we get rental 10 times more. So that is one reason, possibly one reason why the S-REITs are more dynamic in that sense and growing faster in that sense. But I would also tend to observe that S-REITs also tend to be more volatile in terms of their performance. That I would think that it could be potentially due to the fact that their investor space are a lot more bigger, comprising a lot more bigger spectrums from the international investors. So when international investors are more active in their market, for example, in Hong Kong and Singapore, for example, then your price movement or price fluctuations could be more fierce, when the trading comes, because foreign funds tend to trade in a bigger volume than our local investors. So that is what I observe in Singapore. In our Malaysian REIT, I think we are more I wouldn't say conservative, but I think in terms of our level of aggressiveness, definitely I have to say we are less aggressive. In terms of our investor base, our investors base are also predominantly the local institution. Majority are local institution. We do have a bit of foreign investors, but not in a big way. So that also answers the question why, if you look at the REIT prices, they tend to be more stable. So there is also the good part of of less robust activity by foreign trading. In my opinion, yeah.
Okay,
because
thank
it's supposed to provide stability also, like at the end of the day for REIT.
Yes, that's right. I think now we also have an ETF that invests in
Yes,
REIT.
yes,
Yeah,
yes.
we have ETF that invest in REITs so that can give you a larger exposure to
Yeah.
not only M-REITs but also REITs around the world.
Yes, it's around the world, in Asia also. Yeah, so that is a proxy to the REIT market also. If you do not want to go through the hassle of picking, which is the best REIT in Singapore, which is the best REIT in Malaysia, so the ETF is a proxy to your REIT investment.
All right. Okay, Crystal, just now you have addressed the question in comparison between M-REIT and S-REIT, right? So there's another question asked by Kam on Hong Kong REIT. What is your view on that in comparison to Malaysian?
Okay, disclaimer. I am not very familiar with Hong Kong REITs in my study, like my coverage. So actually, I don't look very much into the Hong Kong REITs. So I would say that I may not be able to comment on the Hong Kong REITs, on the Hong Kong REIT space, because we tend to compare a little bit more with Singapore, being that it's closer to home, it's closer in terms of jurisdiction and also closer in terms of our regulations. So we compare a little bit more with Singapore, but not so much in Hong Kong. So I'm not able to comment much on Hong Kong REITs. Yeah. But I think Hong Kong REITs has got some exposure to China properties. In fact, Singapore also, some of their REITs have exposure to China properties as well. Yeah.
Okay. Engi would like to ask, does the distributable income take into consideration of any non-cash item like impairment?
Distributable income does not take, because its distributable income is net of everything and they are equivalent to realized income. So if let's say valuation of properties that lead to a negative revaluation, right, deficit, it is also not part of distributable income. Distributed income is the actual income that is available to be distributed to unit holders.
All right. Johnson would like to ask, the capital distribution portion, is it due to revaluation of the properties? If yes, does it mean that the manager revalue the properties every quarter?
The capital appreciation and depreciation, right? It's purely a function of the market forces, being the movement in the share price or the unit price. In terms of revaluation of assets, it is in the context of REITs are required to value or revalue its assets once every year during the financial year end.
Yes,
that will lead to, in the P&L, either there will be at the end of every financial year, right? You will see that there is a line that says unrealized loss or gain. So that is the revaluation surplus or deficit. It does not necessarily directly translate into the unit price. The unit price can be a function of demand and supply from the market.
Okay.
Yeah.
Let me go through some other questions. Okay, I think many of the question is repeated and has been addressed. I'm not sure if you have the data for ETF on REITs, but the question asked is, what is the return compared investing in M-REIT versus the REIT ETF that is issued by Trade Plus Asia X Japan REIT? Which one offer better diversification and return?
I do not have the data comparison. Yeah. I do not have the data for the ETF because for us, we only look at most of the time the comparison to the to the Bursa Malaysia REITs index, which consists of the entire M-REITs industries, every single M-REITs in the country. That is the closest performance to represent the M-REITs. It's a Bursa Malaysia REIT index.
Okay. For income investors' perspective, what makes REIT more attractive compared to other high dividend yield companies? Especially nowadays, there are a lot of high dividend yield companies, even among the blue chips. So that's good. The question by Lee.
Okay. If I may maybe share a few pointers here, I think you are right. REITs or M-REITs may not necessarily be the only segment that provides high income or high dividend yield, because there are good companies out there also offer very attractive yield. So you are absolutely right, to point out that other companies do provide high distribution or high dividend yield. In terms of, I think ultimately for REITs, what is the differentiating factor is probably one is the consistency of the frequency, because in the context of REIT, we need to pay at least 90% no matter what of the distribution income. And it is also based on what the REIT has committed to the investor, whether on a quarterly basis or a semi-annual basis, we need to pay no matter what. So it's not something that at our discretion that, this quarter we don't feel like paying, then hence we don't distribute. So in terms of predictability of the frequency is definitely there. So I think that is one key differentiating factor or the key difference. Secondly is also, if I may, but you may not agree with me perfectly after the pandemic, we used to say that one of the beauty of REIT is that the properties or the tenants do not disappear overnight. So now, post-COVID, probably I have to have a little bit more disclaimer in this statement, but in normal circumstances, we always feel that whether it's an office building, whether it is a retail mall, even to the context of hotel, right? Our customers and tenants are very diversified, and they are made out of a very large pool of stakeholders or clients. So it is unlikely that they will disappear overnight. What it means to the REIT is also, it is very unlikely that we will lose all our income overnight. Of course, disclaimer, with the exception of the pandemic, because the pandemic has really bring us to an experience that we have never seen in the history of M-REITs, that income can potentially drop to such a low level because businesses are totally closed in the context of, for example, hotel, where totally shut down, or whether shopping mall can only operate based on essential services and the rest cannot operate. And hence, what do? We need to support the longevity of our tenants. Hence, we need to forgo our rental and provide rental support to them or rental assistance. So this is really the first time in the history that we have seen things or income can drop so substantially. Other than that, we feel that under normal circumstances, it is unlikely. Hence, that relate to, again, the distribution of the dividend, right? So if the dividend has been stable and our rental has been stable, it is also unlikely that your dividend will drop substantially over a period of time without any specific reason. So that we feel is also the stability that a REIT can provide, as opposed to an operating company, sometimes, because operating company can rely on contracts, on projects. If the projects or contracts ends and they fail to replenish their projects, right, there may be times where the dividend can drop. So I'm not saying that other companies that pay high dividend has certain risks, but I think in the context of REIT, in normal circumstances, actually our incomes are quite stable also.
All right. Thank you so much, Crystal, for the very nice presentation on this. I trust that all of us here have gotten enough inside scoop of REITs.
Thank you. My pleasure.
Yeah, I thoroughly enjoy your presentation, especially with all the well prepared facts and figures and the returns. So thank you so much for that. So let me share my screen.
I hope the audience has enjoyed the sessions as well, for sacrificing your evening with me.
Yeah,
1.5 hours listening to us.
Yeah, 1.5 hours, and I see that, Crystal, you're still staying up late in the office for us. Yeah, so really appreciate it much.
Just to ensure that my Wi-Fi is strong enough.
Oh, okay. Thank you,
Thank you very
Crystal.
much. Thank you for
So
giving us this opportunity as well.
yes, yeah, let me take over the control for a bit. All right. So to let you know more, today we only have 1.5 hour session. So if you want to learn more about investing, you can head over to www.bursaacademy.bursamarketplace.com. On Bursa Academy, you can get a lot more education on investing. Okay, be in the resources in a sense of articles, quizzes, coursework, and so on to help to build you to become an informed investor. Right, there are a lot more events that are happening on Bursa Academy, so do make sure that you check it out. For our next webinar, it is titled Analisa Harga dan Volume. All right. So when it comes to investing, it's important for us to assess the price accompanied by volume, especially to those technical traders. So this price and volume are essential elements in terms of technical analysis. So if you want to master this price and volume analysis, please tune in to this webinar that's happening on 19 November, which is this Friday, this coming Friday, from 8:30 to 10 o'clock. Our speaker will share with you about his analysis on price and volume. Of course, like the title suggests, it is going to be conducted in BM. All right, so I've given you the registration link in the chat box, and now I'm giving you again. All right, so thank you so much, Crystal. For further information on this presentation kit, you can kindly contact Crystal at the email or also the mobile contact. All right, so with that, thank you very much, Crystal, for doing this REITs the Inside Scoop webinar for us. So hope all of you here have a pleasant rest of the day. Bye, everybody. See you on Friday.
Thank you very much. Thank you.
Yeah, thanks, Crystal. Bye.
Yeah, bye.